Hello and welcome to today's PENTalk. I'm Beth Parker with Pentegra. We're glad you've joined us today. Before we begin the presentation, there are a few housekeeping items that I want to go over. If you have any questions during the presentation, please submit them through the question box that's located on the control panel on your screen. We'll answer as many questions as time allows, as we want to ensure we are respectful of your schedule and end on time. If we don't get to your question during the presentation, we'll definitely follow up with an email afterwards. Also, stored on your control panel in the handout section is a copy of today's presentation, along with some additional resources that you may download now or at any point during the webinar. Now, let's get started. I'm excited to introduce today's expert, Kate Blake. Kate is a senior consultant for Pentegra and has been with us for 10 plus years. Kate works with clients to develop effective plan design and benefit compensation strategies, manage plan level modifications, and build employee awareness and appreciation for retirement programs. She holds CPC, QPA, and QKA credentials. And when you have that many letters after your name, you really know your stuff. Kate knows her stuff. Kate, so great to have you hosting today. I'm going to turn it over to you now.
Great. Thanks so much, Beth, and thank you, everybody, for taking the time to join us this afternoon. Now, I am going to start out today's presentation with a very unconventional question. Does everybody on this webinar like grilled cheese? And you may be wondering, why on earth is she asking that question? Now, bear with me just a minute and it'll all become clear. But back when I was in college, many moons ago at this point, I used to love to make grilled cheese sandwiches on my George Foreman grill. But what I didn't know at the time was that not only was George Foreman the spokesperson for the grill, but he was also a great philosopher. And I say that because he's credited with saying the following. The question isn't at what age I'd like to retire. It's at what income. And you know what? I think that there's a lot of value to that statement because so many of us just think about, I'm going to retire at 62 or I'm going to retire at 65 or any age, and we don't really give too much thought to the details behind what's driving these decisions. That's what I'd like to spend some time discussing today. We'll go through the general idea of decumulation. What does it all mean? But there are certain things that we should be thinking about as we're preparing for retirement, and certain things that we can also help our clients and our plan participants and our employees with as they move through their careers and get closer to retirement as well. Things that we'll discuss today include topics like asset allocation, timing of retirement, finding the right form of payment and taxes. And all of these components are puzzle pieces in this idea of decumulation. So what is decumulation? It sounds kind of like a boring word for a very complicated topic. I think that by breaking it down into these four components, it becomes a lot easier for us to digest as retirement plan practitioners, and then also easier for us to pass this knowledge along to our employees. And given that, what I'd like to do during today's presentation as we go through these four aspects of decumulation is unpack them all and look at them through different lenses. We'll take a look at decumulation strategies and topics from an employer or advisor standpoint. And there we'll look at flexible design options for your plan that can really help employees maximize their retirement decisions. And we'll also put on our employee hats, as I'm sure the vast majority of us on this call today are saving for our own retirements. I'll give you some food for thought to think about as we navigate those waters. Now, I mentioned that the first topic when we're thinking about decumulation has to do with asset allocation. Now, asset allocation, for those of you who don't deal with investments on a day-to-day basis, simply has to do with where are we putting our money, into what different buckets, so to speak. And the transition from savings to spending down our retirement assets is a tough one, and not just for financial reasons, But I tend to think that the process of preparing for decumulation is as much a financial question as it is a psychological question. For the duration of our entire career so far, we've been saving, squirreling away money. This is the accumulation phase. And what I'm showing on the left-hand side of this slide here is an example portfolio for somebody who is currently accumulating retirement assets. Now, what we're showing on the right-hand side of the page is the flip side of that coin. What is this person going to do when it's time to begin the process of transitioning to spending down their assets? Well, while we've been saving, as you can see on the left, we have everything in our portfolio invested according to our risk tolerance. But as we transition to the distribution phase, it becomes helpful for ourselves in our own planning and for us to communicate to our plan participants and employees that it's useful to think about decumulation in terms of buckets. Prior to my working on the employer level with regard to retirement plans, I spent quite a few years working in the employee education area of retirement plans. And something that I discovered while I was in that area and working one-on-one and in group sessions with employees is that the best way to communicate ideas to them so that they stick is to make them relatable. And I encourage you to do that as you talk with your employees and with your clients about retirement. So in the interest of making this discussion relatable, I'll give you a personal anecdote for how I think about this transition to the distribution phase as it applies to me. When I meet with employees, I always try to find something that they are interested in. And for me, I'm interested in gardening. When I think about my garden, I think about it in the form of different buckets. It has a lot of different things going on in it. So bucket one here we see on the right-hand side, this is our bank account. So this is our spending account in retirement where we keep a couple of months of liquid assets that we can use to pay our monthly bills. For me, this is like my garden bed, where in the summertime, not quite yet, but in a couple of months, I'll be able to go out and get a tomato and eat it for dinner. So this is the money that is readily available to us. You can see above that in bucket two, we have our short-term reserve. So this is a way of thinking about the money that we're going to need in the short to intermediate term that maybe isn't living inside our bank account. Maybe it's in CDs, or maybe it's in a money market account, something that will still be liquid but provide you with a slightly higher rate of return. For me, in terms of gardening, I think of my bucket two as kind of like my seeds. That's my short-term reserve. If a mean rabbit comes and eats all my carrots that I have in my garden, well, I can go to my short-term reserve and plant more seeds that I'll have pretty soon. My long-term portfolio is where I have a diversified portfolio, a mix of stocks, bonds, and cash equivalents. And this is going to be similar to the portfolio that I had during my accumulation phase, but as I transition into and beyond my retirement date, what I'll start to think about doing with my long-term portfolio is slowly over time de-risking it. So applying it to me, then I kind of equate that to my winter storage, my winter squash and my canned tomatoes. Those are my long-term portfolio for the future. So I'm going to have that invested in a slightly different way than my short-term money. So I like to make things relatable because I think it helps people remember it. And indeed, that's why I started today's webinar with a reference to George Foreman and grilled cheese. Because probably the next time now that you go to make or eat a grilled cheese, you'll think about decumulation and you'll think about these pieces of this retirement puzzle. The same thing applies here. So from our perspective, break it down and really think about these choices as we navigate through our careers and make it relatable as we communicate this information to our employees and to our clients. Another way that we as practitioners can ensure that our employees and our participants' needs are being met as they navigate these waters into the decumulation phase is to make sure that we're offering a broad retirement plan fund lineup. We want to all make sure that our individual retirement plans, our 401ks that we sponsor and that we offer to our employees and clients, include all the major asset classes, stocks, bonds, cash equivalent funds. We may also look to target retirement or asset allocation funds, which help employees achieve balanced and diversified portfolios. And in the case of target retirement funds, they de-risk automatically over time. So by making these options available to employees within their 401k plan, we're providing them with all the tools that they need to de-risk and to adjust their asset allocation as they move through their careers. Now, when we're wearing our employee hats and we're thinking about asset allocation, or if we're communicating with employees and helping them plan for retirement, there are a couple of key questions that we can think about and ask them. Number one, perhaps the most obvious, what are your income needs? And this ties back into that bucket one that I mentioned earlier. That's going to be our checking account where we pay our bills from. Of course, it sounds trite and nobody wants to do this, but we should encourage our employees and participants and ourselves as well to do a budgeting exercise. Figure out what our monthly and annual income needs are, because that'll help us answer the other questions, like this one. Do you plan to use, or do your participants or employees plan to use their assets now or in the future? The answer to that question can help you determine things like, what's the right asset allocation for me? We can ask our employees and participants about any other assets that they may have available. And for those of us in advisor roles, that can help you better guide them through the process. And what is your risk tolerance? This is going to become important as we begin the process of de-risking. The way that our portfolios and our employees' portfolios look today will probably be different from how those portfolios look into the future. So what are some things that we should think about as we're thinking about our asset allocation? Well, risk tolerance, I just mentioned, as one of them. And age is another factor to consider as well. I'm sure most of us as retirement plan practitioners know that the farther we get into retirement, the older we get, the less risk we're generally going to want to take, simply because we're going to need that money sooner. This is from the Schwab Center for Financial Research, and I thought that this slide was interesting because it provides some ideas for asset allocation as we move through our retirement. While we're in our 60s, it would be prudent to imagine, again, pending our own individual risk tolerance, that we could probably be okay with a moderate asset allocation. We're in the early years of our retirement. We're not going to be spending down too much of our assets right now. And also in the early years of our retirement, we still want to make sure that we and our participants have enough risk in our accounts that we can still see some growth, but not so much that we'll be subject to wild fluctuations in the market. So you can see with this moderate portfolio that it really does have a broad mix, 35% in fixed income, 5% in cash, and the rest in equities. Spreading out our risk in this way allows us to smooth our rate of return over time. And this is very important in the early years of our retirement where, as I mentioned, we really do need that income. To give another anecdote, when my grandmother retired, she was extremely risk averse, and she had all of her money in cash. And at that time, the stock market was rocketing up, and she really did herself a disservice. On the flip side, though, thinking back to 11 years ago now, back in 2008, we saw what happened with individuals who had the vast majority of their assets in stocks. So finding that middle ground is key, and it's key to communicate that to our employees and participants as well. What we should also communicate to them again is as we move through our retirements, we'll want to think about de-risking. So the middle and right charts are showing examples of what an appropriate asset allocation might look like for individuals at various stages through their retirement. And the purple here represents our fixed income and the green represents our cash. So we can see how this de-risking works as we move to the right on this page. So asset allocation is going to be a key component. It's not a static thing. Our asset allocation will change as we continue on into our retirement. Something else that we should think about when we're thinking about our investments, and something that is worth communicating as well to our employees, is the idea of rebalancing. For those of you who aren't familiar with this topic, rebalancing is the process of setting our investments back to the way they originally were when we made the elections. Now, you may be thinking, what is she talking about? Why would my investments change if I didn't tell anybody to change them? Those of you who are well versed in the website or in investing may be aware that it has to do with underlying market performance. Let's say I had an asset allocation of 50% in stocks and 50% in bonds as of my retirement date at age 65, and I felt that was appropriate for me. Well, unless I rebalance in, let's say, 5 years, I would bet dollars to donuts that my asset allocation is not going to be 50-50. And why? Well, let's use a current example. The stock market is not too far off from all-time highs right now. So in our real-world example, I would be willing to bet that this individual's asset allocation is more heavily weighted towards stock. Maybe now, after 5 years of market gains, instead of a 50-50 split, maybe it's 60-40 or even 70-30 to stock. When we rebalance, we set it back to that 50-50. And that's really useful for retirees because what we can see here is that a moderate portfolio has about a 65% chance of maintaining its targeted risk level over time. But there is also a 30% chance of exceeding our targeted risk level, again, just by virtue of that underlying performance. So rebalancing is key, especially for retirees and soon-to-be retirees who may be starting that process of thinking about de-risking. At Pentegra, we do offer an automatic rebalance feature, and it's available on our participants' website. It's going to be located under the Account Transactions drop-down menu. It's completely free, so if you're in an advisor or employer role, you can mention it to your employees and participants that it is out there. Employees can opt in or opt out of rebalancing anytime, and they can do it on a monthly, quarterly, or semi-annually or annually basis. This is a great feature because it does take that guesswork out of our asset allocation. When we set a schedule or when we encourage our employees to set a schedule and stick to it, we're much less likely to hem and haw about the day-to-day fluctuations in retirement, which can be a dangerous pastime after we stop working. So asset allocation is important. Rebalancing is something to consider. But what else should we be thinking about when we're thinking about decumulation? Well, timing is very important. Thinking back to what George Foreman said, what income level would we like to retire at? That's going to be a key determining factor when we're thinking about timing. And how long are we expecting to make this money last? That is also going to help us figure out when we can start drawing on it and how much we can draw down our accounts each year. There was a rule of thumb that's been floating around for quite a while where it says that you can probably safely withdraw somewhere between 3 and 4% of your assets each year and still maintain your account balance. But you know what? There's so much more to that rule of thumb. We should also be thinking about, again, how long are we planning to be in retirement? What do we feel about our longevity? What is our risk tolerance? Because all of those things, when we look at the numbers on the right here, will tie into how much we can take out each year. For example, if I am a conservative investor and I expect to live 20 years in retirement, well, it's probably a safe assumption that I can withdraw about 5.1% of my balance each year and have it last for the remainder of my lifetime. What if I think I'm going to live for 30 years, though? Well, now I can only withdraw about 3%. So this is a great reference that you can use for yourselves. And as Beth mentioned at the beginning, this presentation is available as a handout. So feel free to share this with your employees and plan participants as well. Again, it can kind of help guide them in figuring out how much can I reasonably take out of a 401k or another defined contribution type account. Also, when we're thinking about timing, we should think about the different types of plans that we have. The prior slide was primarily in reference to our defined contribution plans. So these are our account balance type plans. These are going to be our 401k plans, our profit sharing plans, our ESOPs, but it also applies to things like IRAs. Now, when we're thinking about timing with defined contribution plans, generally speaking, distributions may be made upon attaining age 59 and a half, penalty-free. Of course, keep in mind if the money has not yet been taxed, it will be taxed upon distribution at ordinary income tax rates. And on the flip side, we need to begin receiving the funds no later, generally speaking, than age 70 and a half. That's when our minimum distributions kick in. So with our defined contribution plans, we have a tremendous amount of flexibility about timing. But again, think back to that prior slide and think about how long you need this money to last you. And as far as distribution methods in those type of plans, we generally see them paid in full or partial lump sums or in installment payments. When we're thinking about the timing of our defined benefit plans, we approach it from a slightly different perspective. Although the same general rules apply, early retirement ages usually exist in these pension-type plans, but the age will be defined specifically by the plan. Also keep in mind with defined benefit plans that benefits are generally reduced for early payment. So if you're thinking about retiring early and you have a pension plan, take that into consideration. And remember, if you or if your client's plans do not have any cost of living adjustments or increment payments built into them, inflation will eat away at that monthly payment over time because that is a fixed income portion of our benefit, assuming we take an annuity. And again, minimum distribution rules apply to our pensions as well, where we usually need to start taking this money by age 70 and a half. And our pensions are typically paid as either lifetime annuities or lump sums. Social Security works very similarly to pension plans insofar as the benefits are paid as a lifetime annuity. Social Security also has early retirement ages. It starts as early as age 62. And again, payments should begin at no later, I should say, than age 70. So we're looking at timing, and we're also looking at the different types of plans. We should also think about the different forms of payment that those plans offer. There is a wide world of retirement plan form of payment out there. We have lump sum distributions, lump sum rollovers, partial distributions, installments, and annuities. Not every plan, as I'm sure everybody knows, offers every distribution option, but between your various assets or your client's assets, you probably have a couple of these different options out there. So let's go through them and let's look at the pros and cons and take what we've learned so far and try to figure out how can we figure out what the best distribution options are for us, and how can we guide our employees and our clients along the way as well. Some questions that we'll be asking as we go through the next couple of slides include things like, what's more important to you, flexibility or predictable income? And these questions are great to ask your employees and clients as well. How important is estate and beneficiary planning? Because this will have an impact on which assets you draw first and when. And we mentioned this earlier, but health and longevity also plays a role as well. For example, if you have a pension plan, it's possible that that pension plan may offer an additional benefit for deferred receipt after age 65, just like Social Security does after your normal retirement age. And if health and longevity runs in your family, that may be a good option to defer payment. But if health and longevity don't run in your family, it may make sense to take it early. And that's why I said earlier that planning for this decumulation phase is as much money as it is psychology. We want to think about our family history and our needs, in addition to the dollars and cents. Now, with those three questions in mind, let's take a look at these different distribution options. So we mentioned the lump sum distribution. This is where we take a full distribution payable to us, generally putting it in a checking or savings account or something along those lines. The upside of a lump sum distribution is that, as I'm sure we know, all the money is available to us all at once. Now, I don't have it on the slide, but I'm going to say here in a tongue-in-cheek way, the downside of a lump sum distribution is the same. We have access to all of this money at once. The entire distribution is subject to taxes. Lifetime income is not guaranteed, and we could potentially outlive this money. But we do have the freedom to invest on our own and all the flexibility in the world. The other side of the coin there with regard to lump sums is a rollover. Instead of taking the money for ourselves there, we roll it to an IRA or to another 401k plan. This is useful for consolidation purposes. It also is useful for taxation purposes, as taxation is deferred until we ultimately receive the money. On the downside, there's a little bit of administrative work. You'll need to figure out where to roll the money to, and we don't have access to those dollars right away. But deferring taxation and consolidation are big pros. when we're thinking about rollovers. And by the way, this doesn't only apply during the decumulation phase, but the accumulation phase as well. If you have outside 401ks or IRAs, it's worth considering rolling them into your main account, whether it be your 401k plan here or somewhere else. Installment payments are a useful option because they do give us somewhat of a consistent, steady, and reliable income. However, there is the possibility of outliving your distribution time period. In addition, with installment payments, we're taxed only on the amount that's distributed, and that's different from a lump sum distribution where we're taxed on everything. So installment payments are useful if you'd like to have a relatively steady income level from year to year over a specific time period, and if you'd like to minimize your tax burden from year to year, because lump sum distributions generally bump us into higher tax brackets, where installment payments may not necessarily do so. Annuity payments are generally offered by pension plans, and they provide us usually with lifetime retirement income. It's fixed and predictable. We always know we're going to get paid every month. However, once they're elected, that form of payment usually can't be changed, and we can never get more out of an annuity. But annuities are very useful because they answer an important question. Am I going to outlive my money? With an annuity, the answer is no. At Pentegra, we do offer some annuity solutions that we can help you with. We partner with an organization called Hewler, where we offer an out-of-plan annuity option for those who are participants in our 401k plan products. This is available on your employees or your participants' website. It's located under the retirement plan heading. And this allows employees with advisors' help or on their own to shop the annuity market if they'd like to take some of those 401k dollars and annuitize them. We offer institutional economies of scale, so generally speaking, lower pricing, although of course annuities, if we purchase them on the private market, generally do have fees associated with them. So that's another factor to consider. We should also be thinking about everybody's favorite topic, taxes. I alluded to this earlier, but generally speaking, our retirement plan distributions are subject to ordinary income tax. That includes distributions from most qualified plans, so 401ks, profit sharing plans, pensions, things like that. Remember, again, with limited exception, there's a 10% excise tax if distributions are taken prior to age 59 and a half, although there are some exceptions to that rule. For example, if you start your benefit at age 55, receive it over at least 10 years, and take installment payments or otherwise substantially equal payments, in the words of the IRS, that penalty is waived. So the penalty doesn't always apply, but be sure that your employees and your clients read the special tax notice that comes with the distribution paperwork prior to making an election, because it discloses any taxes and penalties that may apply. Do your plans offer Roth? If you're a plan sponsor or advisor and your plans do not offer Roth contributions, it's worth thinking about adding them. As you probably know, with Roth money, our distributions are tax-free, provided that we've held the account for at least 5 years and are at least age 59 and a half when we access the money. If you have younger employees, if you feel your demographics are changing over time, Roth is even more valuable. The younger the employee, the more valuable Roth is to them. We offer Roth contributions at Pentegra. Additionally, we offer an in-plan Roth conversion functionality. So if you don't already have that, feel free to reach out to us, and we'd be happy to help you get set up with that in your plans. Think also about where you'll be living in retirement. As we know, some states have no income tax. These are the states we all want to live in: Florida, New Hampshire, Nevada, things like that. I live in New York, which most definitely does have income tax, so I may be looking at this bullet point when the time comes for me to retire. And remember that if you are working and collecting Social Security at the same time, I didn't mention this yet, but there may be an adjustment to your payment depending on your income level for that year. So if you're guiding employees as they're approaching this decumulation phase, that's worth mentioning as well, because there are a lot of folks out there who are collecting Social Security these days and working at the same time. And we want to make sure that they really do maximize their benefits. So again, these 4 pieces, when we look at asset allocation, timing, forms of payment, and taxes, these will help us complete our retirement puzzle. And it's useful when we're thinking about retirement for ourselves or helping our employees to think about all of our different income sources and ask ourselves these 4 questions or these 4 points with regard to each one of them. When we look at all of our assets and when we have these questions answered, that is setting the stage for us to really achieve a secure retirement where we have income stability and lifetime income for ourselves. And it will allow us to finally take the time to enjoy that time and do what we truly like every day. Well, with that said, Beth, I'll turn it back over to you to open it up for any questions or comments. Thanks, everybody, for listening for the last half hour as we talk decumulation.
Thanks, Kate, so much. That was terrific. We do have a couple questions. I know we're right up against our ending time, but let's see if we can get a couple of these in really quick. What is the most common form of distribution that you see?
Oh, wow, that's a really interesting question. So I actually used to work in the pension area, so I processed a lot of distributions, and I find that it tends to be cyclical. When I started working in the pension area, it was just shortly after 2008, and I found that people were a little bit scared, and I saw that people were opting for more annuities. But as the market has ratcheted up over the last couple of years, I start to see the tide turn a little bit. I'm seeing more people opting for lump sums and lump sum rollovers to IRAs. Great question.
Yeah, I think the next one is also interesting. What age on average do people typically tend to start collecting their benefits?
Well, yeah, this one's an interesting question too. And actually, in this case, the experience that I've had with regard to retirement plans doesn't really match the official statistics. So I'll tell you about the statistics and then I'll tell you about my experience. According to the Social Security Administration, the most recent statistics that I saw, the average retirement age in the United States is 62 years old. And when I read that statistic, I was shocked because it was actually a little bit earlier than I thought it would be. Coming back again to when I used to process those pension benefits, when I first came to Pentegra, I felt like I was processing early retirement benefits all the time. But over time, I noticed a lot more people delaying retirement and taking their pensions later and later. Perhaps it has to do with the demographics of the plans that we administer. We always try to make sure that people are educated about all of their options. But so far, it looks, at least according to government statistics, like the vast majority of people are still taking early retirement.
Interesting. Okay, well, again, Kate, thank you so much for being here, and thank everyone for joining us today. We're just a few minutes past our deadline, so thank you for sticking with us, and hope to have you on our next PENTalk. Thanks,
Great.
Kate.
Thanks so much, Beth. Thanks, everybody. Bye-bye.